Good evening. On behalf of the Reserve Bank, I have great pleasure in welcoming Professor Kenneth Rogoff, who will be delivering the 14th L.K. Jha Memorial Lecture today. I also extend a warm welcome to the daughter of late Sri L.K. Jha, Srimati Deepika Maharaj Singh, who is with us today. We are delighted to have you here. Of course, a warm welcome to all the distinguished invitees here with us today. Let me start with a short word about Mr. L.K. Jha. He was an eminent economist and studied economics at Cambridge when Keynes was teaching there, and also at the London School of Economics. He was a distinguished administrator and an able statesman. He helped shape the country's economic policies for nearly 4 decades. He had a significant role in the Industrial Policy Resolution of 1956, which set India firmly on the way towards a mixed economy. He was the governor of the Reserve Bank, the 8th governor, between 1967 and 1970, and contributed to the strengthening of the banking sector. It was also during his tenure, I should mention, that the major commercial banks were nationalized in 1969. He was the first governor of the RBI whose signature appeared in Hindi. He served as the Indian ambassador to the United States, governor of Jammu and Kashmir, as well as a member of the Rajya Sabha, which is our upper house of parliament. Besides contributing to monetary policy as chairman of the Indirect Taxation Inquiry Committee, he made numerous valuable contributions towards improving India's fiscal system. Not only was his expertise in the field of economics recognized and utilized domestically, it was also utilized internationally. He was the first Indian chairman of GATT. He was also chairman of the UN Group of Eminent Persons on Transnational Corporations, member of the Interim Coordination Committee of the International Commodity Agreement, and a member and later deputy chairman of the Brandt Commission during the 1980s on North-South economic issues. He argued for a new economic order and laid emphasis on strengthening international institutions, which in his view could contribute immensely to the betterment of developing countries. He pleaded the cause of India and other developing countries in many international fora and asked for a new world economic order in which the developing countries would have a more equitable share. He wrote on a wide range of topics, including banking, monetary policy, credit, and international payments. He authored several books, such as Economic Development, Ends and Means, Shortages and High Prices, The Way Out, Economic Strategy for the 80s, Priorities for the 7th Plan, the North-South debate, and so on. One of his books, Mr. Red Tape, was a collection of articles and transcripts of speeches on Indian bureaucracy, which was a satire on the bureaucratic procedures of the country, and he clearly knew what was wrong with it. He championed the cause of liberalization much before the Indian economy started liberalizing during the 1980s. He believed that notwithstanding short-run trade-offs, in the long run it would help the economy by promoting exports and improving competitiveness. The Reserve Bank of India instituted this lecture series to honor the memory of Sri L.K. Jha, and it started it in 1990. So far, 13 memorial lectures have been delivered, last one by Tharman Shanmugaratnam, Deputy Prime Minister and Minister of Finance of Singapore. Turning to our distinguished speaker today, it's a privilege to introduce Ken Rogoff, who was my predecessor at the International Monetary Fund, as well as a very good friend. Ken is also a former director of the Harvard Center for International Development. He is currently the Thomas D. Cabot Professor of Public Policy and Professor of Economics at Harvard University. His areas of research cover a wide canvas of global economic issues, including exchange rates, international capital flows, and monetary policy. He is well known in central bank circles for his work on central bank independence and inflation targeting, as an institutional device for enhancing the credibility of monetary policy. He's an elected member of the National Academy of Sciences and the American Academy of Arts and Sciences, as well as on the Council of Foreign Relations and the Group of 30. In 2011, he was awarded the biennial Deutsche Bank Prize in Financial Economics for his work on sovereign default and debt restructuring, global imbalances, and the history of financial crises. All these, of course, are highly relevant for understanding the international environment today. Ken has a monthly syndicated column on global economic issues published in 13 languages in over 50 countries. He's most recently known for his book with Carmen Reinhardt called This Time is Different, 8 Centuries of Financial Folly, which explains why crises keep recurring across time and countries. It is a bestseller and has won various important awards. Now, many of you may know Ken as an academic. However, he's one of those exceptional people who excel at many spheres. In particular, he's not only a distinguished professor, but also a former, I should say, a current international grandmaster of chess, a very rare combination. He has many friends in chess circles, including our own Vishwanathan Anand. He says that every year he receives an unsolicited letter from one of the world's top chess players. Although the precise content of the letter differs year by year, the question essentially remains the same. How can I get out of chess? Possibly he's in a good place to answer this because he himself faced this dilemma on whether to pursue a career in chess or in academia very early on in his career. I think academics has benefited tremendously from his choice. Professor Rogoff will be speaking on policy debates in the aftermath of the financial crisis today. This is clearly a very topical issue, and I will not stand between you and Ken any further. And the stage is yours. Thank you.
Thank you very much. I'm just trying to figure out how to start. Great, and I just use the page down, page up and page down. I want to help improve the reader experience. I don't want to seem like a bad global citizen. What's that? Is that good?
Translate as possible.
Okay. Great. Thank you. Thank you very much. Thank you very much for coming here today. Thank you very much to Raghu Rajan for that kind introduction, and it's a great honor to be giving the L.K. Jha Memorial Lecture. I follow many very distinguished people who've given this, and he was certainly a very distinguished man himself. And I haven't been in India, I'm embarrassed to say. I have no good excuse for a very long time. I last came in 2005. And so it's also been a long time since I've visited the Reserve Bank, which was a very exciting place then, and I think a very exciting place still today. I'm going to talk about some of the issues that have come up, I would say, in the aftermath of the financial crisis. I'm going to take a fairly long-term view in many of the things I'm talking about. I promise I will say something about the taper because everyone asks me, practically stops me on the street if I look Western to see if I have a view on the taper, and I am going to talk about that later, but forgive me if I only gradually work my way into that. And I think, sort of a question on a lot of people's minds, it's certainly here in India, but it's very much in the United States and Europe and Japan, is how long is it going to be slow growth? What is really going on? And I think it's fair to say that particularly the financial crisis, which I've worked on a lot over many years, working on financial crises, I think it's fair to say that this started in advanced countries. It was caused by the advanced countries and propagated by the advanced countries, that it has left a lot of risk to emerging markets, and part of why everybody's concerned about the taper is various uncertainties that come from the advanced countries, and I will come to that. If I was sort of to give a bird's eye view of where things are, the U.S. had this almost improbable growth spurt from 1995 to 2005, and I'm old enough to sort of been before and after. Nobody expected that. It was almost like having another child when you're very old and you didn't think it was going to happen, where this was this mature economy, everyone was catching up, and now it seems obvious, it was the tech boom, whatever. I don't think it was obvious to anyone going into it that was going to happen. It was somewhat, incredible. And Europe had a growth spurt that came a little later. It was just developing really as when I was at the IMF. I think in my last press conference at the IMF was as there had been a recession, but Europe's growth wasn't developing. I said something like, if Europeans want to see a recovery, they're going to have to watch one on TV. I was seeing it in the United States, but they did, and they had a growth spurt. And of course, emerging markets had done extremely well. The financial crisis came. They did much better recovering than the advanced countries, but things have cooled off a bit. So if I first talk about the debate in the advanced countries, which is where I'm going to focus, I am going to come to talking about India and emerging markets. There's a big debate about whether there's a magic bullet. Is there something that you could have done that would have made things much better? Could monetary stimulus have been done better? Could fiscal stimulus be much more? What structural reforms are missing? And before I go into any of it, I will say I think economists definitely have something to say about this. On the other hand, I've said my whole professional career in different contexts, at least said it to myself, whenever you see an economist say they're absolutely sure about something, you can be absolutely sure that they don't know. And I think you should take some of these policy prescriptions and some of the things that have been promoted with a grain of salt. I mean, we start with what happened, exactly what happened. I'm going to come to my view. I think it was the financial crisis is most of what happened. Yes, there's an overlay of globalization, technology, demographics, but I think that what the United States experienced bears many of the markings of a classic financial crisis. It still looks that way to me. But there, as academics works, and I'm very glad of this, there's a big debate. I would say the view that Carmen Reinhardt and I espoused has probably become the central one, but you never know, where it'll be in 5 years. So I was actually at an IMF conference that was in honor of Stan Fisher, a great man, and until a once and future central banker, it seems. And there were a number of prominent speakers. Larry Summers gave a wonderful speech in the panel that I was on, also with Ben Bernanke, where he was looking at things and saying, I think this is all about the financial crisis is just an exaggeration, that there's something broader going on. And he used his speech has been described in this almost Marxian terms as secular stagnation. He particularly pointed at low interest rates, which I'll come to. There is another point of view, which is that it's a real mega trend view, which is, the last 200 years, 225 years, they've been fantastic. That's it. It's not going to keep up like this. It's been fantastic because we were living with nothing. We hadn't discovered anything. Then we had the Industrial Revolution, and we had a second Industrial Revolution, and perhaps a third Industrial Revolution. It's all petering out, and we're going to have slow growth. Robert Gordon, a very prominent economist at Northwestern, has espoused this, and actually Peter Thiel and Gary Kasparov, he's a former chess player, also have a book about this, where they say there's an innovation crisis. There are a number of others. I will represent them by Jeff Sachs, who said that this long-term secular problems in the advanced countries were understated. They were more serious than we thought. They were exposed by the financial crisis, but it's not really just the financial crisis at all, and that they're missing structural reforms, basically, in the advanced countries. And, well, this is a very big topic, so there are actually a lot of people with advanced ideas. Another one is that policy's just been very uncertain. Hard to argue that it's been very uncertain if you're looking at Europe, if you're looking at the United States, and that this heightened policy uncertainty is actually a big piece of what the problem is. And if policy were more decisive and more stable, things would be better. Demographic factors, it's hard to argue there that there are not demographic factors going on in most other parts of the world besides this one, where they're slowing population growth rates, having a big effect. And finally, there's what I would say is my point of view with Carmen Reinhart, that this is especially the result of a financial crisis. Now, I want to particularly harp on this issue of why interest rates are so low, because that's at the heart of the secular stagnation view, that, you know what, interest rates have been low. That started before the financial crisis. And by interest rates, we mean long-term policy interest rates in the advanced countries. Alan Greenspan, now 8 or 9 years ago, described this as a conundrum. That word was widely used, why they were so low. I think we still aren't sure. Again, there are many theories of this. So slowing population growth is one. And I'll just say as a footnote, if that's really it, some of the prescriptions about what to do wouldn't be the same. If you have slowing population growth, then hyperactive investments not necessarily the cure for that. There's the fact that there had been high saving in many of the fast growth emerging markets, China, Asia particularly. Also, Germany and Japan save a lot because of their aging populations. And then there are other more finance-y technical arguments having to do with that it used to be, back in the stagflation days and maybe the decade that followed it, when something was bad for the stock market, it was bad for the bond market. They moved hand in hand because inflation was high. Then it changed to where when growth was slow, the stock market went down, but interest rates went down and bond prices went up, and they were negatively correlated, and that made bonds a hedge. So instead of bonds being something that were correlated with the market, they were a hedge. You could get lower interest rates for that. Liquidity is a possibility, where there are markets where the liquidities become more and more valued. Another idea, which is very well documented, not very well documented, it's not quite the word for it, but very well articulated by my colleague Robert Barrow and a number of others, is that if you have just a small change in people's concern that something really bad is going to happen, like a bad financial crisis, as an example, that does things, and I've mentioned policy uncertainty. I've seen papers on all of these things, and I think it's fair to say that we quantitatively don't know which of these is going on. We know the interest rates are low, but it's not, since we're not quite sure what was going on, it's not that easy to say how it'll unwind. I mean, I think this is one of the huge calls in trying to think as a policymaker, where are they going to be in 10 years? If I had to guess where they're going to be in a year, and I'm talking about real interest rates, inflation-adjusted interest rates, I bet they're going to be pretty low still. But I think that's a source of uncertainty if you're looking out 5 years or a decade. This is a graph taken from a St. Louis Federal Reserve database that shows inflation index bonds, 10-year constant maturity bonds, and you can see that interest rates had gone way down during the financial crisis, although they started to come back up. I can talk more about the secular stagnation view, except to say, I think that there certainly is an overlay of some of these factors, but I'm kind of skeptical that that's the main thing going on. That I think it's something else. So there's this other view that there just that innovation isn't coming around anymore, the Gordon, Thiel, Kasparov view. And actually, if you go around and talk to my 60, 70-year-old colleagues in chemistry, physics, biology, it's surprising how many of them agree with this. I mean, they don't look at it from the economists. They're not quoting any economists when they agree with it, but they say, well, by gosh, in my field, everything was solved in the 70s and the 80s, and there hasn't been any real innovation since then. But then if you go talk to the 30-year-olds, they somehow, no one told them about this. They think they're discovering really exciting things that are going to change things as much. But we'll see. So the crux of this argument, which I'll just sort of skip through quickly, was basically that there were these fantastic things that really changed our lives originally, and I've got them listed up here. I won't recite them. But the example Gordon gives is he said, look, which would you rather have, and this is particularly poignant here, but which would you rather have, the internet or running water? You would say running water if I could choose. And of course, I think that's true, but it doesn't mean that you're not getting a lot of growth from also having the internet. And they're very dismissive of the third industrial revolution, which had computers and the cell phone. And Robert Gordon comes to a calculation that if we're looking at the United States, it would be very lucky to just get 1% productivity growth for the next century. Now, other countries would get faster because they catch up, but the leading country sort of sets the edge and shows where it's going. And Gordon points to a lot of other headwinds having to do with globalization, inequality, and education, but the center of it is whether or not we're going to have innovation. And of course, if you do, that eventually benefits everybody. As I said, I'm very skeptical that innovation has actually slowed, that's something that's actually changed in a dramatic way. I think scholars of innovation and economic history point to the fact that when you build big databases, it helps research. When you build new instruments, it helps research. That there's no reason to look at things and think that we live in a world where there would be less. Frankly, when I look at advances in artificial intelligence, it worries me much more from the point of view of thinking ahead 25, 50 years, that innovation might happen too fast for man to adjust rather than it will happen too slow. I don't want to sound like a syndicalist, but it does worry me. And Raghu mentioned my former life. When I was a teenager and somewhat in college, I was a professional chess player. And back then, we sort of saw computers coming a little bit, but really, they weren't here. And then, of course, famously in 1997, Garry Kasparov lost to Deep Blue, the IBM computer. He was actually still better then, but he didn't take it seriously enough. But over time, they've gotten better and better, and I can describe it in a few ways. They reached a point where you could get help from a computer and it would tell you what the right move was. Then it changed to where if you saw what the computer thought was the best move, you would have no idea why that was the best move. You don't understand it. And you even see when people comment at none and say, well, the computer says this, but even if you knew that, you wouldn't do it because you don't know why. I mean, they've gotten much better. And they also have a certain level of artificial intelligence by I can't easily tell when a computer's playing. I haven't played in 30 years. I don't follow it, but I was recently in London, and I saw my friend Vishy Anand there, but I asked a number of chess players about this. Can you tell? And they said, oh, no, you shouldn't worry. We can't tell either. And to me, I mean, I think of chess as being, sort of an expression of someone's personality that you can't tell that it's a computer. But then they added, this was interesting, if two computers are playing, we can tell right away. So it's something about the human affecting the computer's interaction. We see certainly advances in biomedicine, artificial eye, that's a very exciting area. I think the energy revolution, shale gas are all big things. I also would say, and I haven't really studied this beside reading the literature. I feel like it's not adequately studied. But I think that our price indices don't necessarily do a great job of measuring over long periods what really changed. So there are things that happen that the statisticians try to take account of. Cell phones were an example. I know that's been around a while, but the internet and social networking, that's another thing. These are things that have very dramatic effects on quality of life. Let's just say, as a parent, I'm not sure I see them all as positive, but at least my kids do. And I think, most people see these very positive, but they're very hard to measure. And, you see these statistics about, how prices have changed over 20 years. For example, the real wage hasn't gone up. And I think there are very important social issues there, but I'm not necessarily sure that comparison's a terribly meaningful one. I would guess that even with the adjustments they make, that you tend to somewhat overstate inflation in terms of actually maintaining the same welfare level, quality of life. They're very hard to measure, so I would also point to this. So I tend to think the idea that we've run out of ideas is improbable. I'll make that statement here, and if I prove to be wrong, I'll probably be dead. But it doesn't look that way to me in the near term. Oh, by the way, this is for nothing, but I played an exhibition game. It's my only game in 30 years with Magnus Carlsen. So here's a picture from it. It's an exhibition game for charity. Another view is that you can't just look at a lack of demand, which has been emphasized a lot, but you have to look at the supply side. And particularly, I think you can go through Europe and find similar things. I'm taking from Jeff Sachs here, who just bemoans the fact that the United States, particularly through policy, has just not adjusted quickly to the changes in the world. And in some sense, the financial crisis warehoused that for a while. That's not the right word. It delayed it. It delayed adjustments to all these changes of globalization. Our infrastructure, is much below that of many other advanced countries, and it's sort of a failure to take hold of reforms is really what the problem is. And then I mentioned these other areas, policy uncertainty. I won't go into any great detail, but it's certainly, there are papers, there's a debate about it, like about all of these things, that I think legitimately argue we're just not sure what's happening next. And if you look at the United States and look at fiscal policy in particular, it is hard to know what's happening next. There's this incredible divisiveness between the parties, with the right wing becoming more right wing and the left wing becoming more left wing, and it's very evenly balanced in the population and makes it very difficult to say what's going to happen next. It's not just a question of what's right, but what is the policy world going to actually deliver? What's the political world going to deliver? And this is, frankly, as they document in these papers, typical after a deep financial crisis. So that one's a little more encouraging, because sort of eventually this would be resolved. The changing demographics is certainly there. I think if you work through a model, it's hard to get as big an effect as we've seen on the real interest rates. Governor Shirakawa, who stepped down recently from the Bank of Japan, actually wrote some papers about this, saying, okay, I know we have low interest rates, but if you look at other Asian countries, every time their population growth rate slows down dramatically, they seem to run into the same problem. My favorite explanation, and I think it really has to be 2/3 of what's going on, if not more than that, is that this just is typical of what's going on after a deep financial crisis. And it's amazing how much the U.S. has followed the markers of a deep systemic financial crisis, not just a minor financial crisis, but a systemic one. So actually, in my 2009 book with Reinhardt, the average of the post-war crises was exactly that housing prices start rising after 6 years, which they did. Equity markets often do well much sooner, passing earlier peaks. In our book, we confess that we have no idea why that's true, because the economy doesn't do well, and it's true. And this is a table which is basically taken from The Economist magazine, which was taken from a January 2009 paper of ours, which in turn was part of our book, where the middle column gives the cumulative real change in these different variables, and the right-hand side gives the duration. This is from peak to trough. So how many years from the top to the bottom? And you can see that housing prices typically falling for 5 years and unemployment almost the same amount. I think, in fact, trying to think about recessions in the conventional view is just very misleading in this context. So the way the National Bureau of Economic Research dates recessions is they say, when do you start growing again? And I think after a deep financial crisis, that's a very misleading question, because you go down so fast and you come up so slowly. The right question, which we frame in our book, is when do you get back to where you started? And at the moment, the United States and only a couple other countries have achieved this. Very few countries, if you do it by per capita GDP, that it's been that's very typical. Now, certainly, I would another piece of what is going on is that there's still an enormous amount of debt in the economy, in the private sector, in the public sector. A difference between advanced economies and emerging markets. In the advanced economies, we're in a position to sort of bail everything out, to not force deleveraging. That was good, and putting a floor under things. Maybe, we will come back to that, but it also means that you have these problems linger. And so in this graph, the dark purple are the advanced economies, the smaller, lower lines, the lower graph is the emerging markets. And you can see the emerging markets didn't have this huge spike, and this is private sector debt. And if you were to look at public sector debt, we would show this very large spike after the crisis. And I don't think there's any question that this overhang of debt, both public and private, is part of the reason that growth is so slow. It limits policy, it limits, people are deleveraging, governments are being cautious, and these are both all some things that are very, very typical of the aftermath of a financial crisis. Now, so if I were to go back to the diagnosis, remember I said that if an economist says they're absolutely sure they know what's going on, you should be sure they don't. So the last thing I want to say is that I'm sure that everything driving this is a financial crisis. I don't know. I don't think anyone knows. I do think that's a big piece of it, but accept that there's all of these other issues that I mentioned are important. I think where you come to a consensus across almost all of these explanations is that if you're growing slowly and interest rates are really low, that's a good time to build infrastructure. You're borrowing cheap, and you're doing something that eventually pays for itself So your debt might temporarily go up, but in the long run, you don't have to worry about it. I would say there's a qualification. That's not necessarily the case if you buy the demographics argument. I mean, for the obvious reason that if you're doing a lot of investment and the labor's not coming, because that's not what the problem was, you get a different answer. My instinct is adding up all of these factors. I think there's just sort of a no-brainer about the fact that there should be more infrastructure investment. And I started out with Larry Summers' speech. That was a big theme of his talk, and I've certainly been saying that for 5 years, and I completely agree with him. However, and I say here there's sort of a point of more debate. I think it's very clear if the infrastructure does something. If you're building a road between two places that need to get connected, and maybe I'd add to that if you're building it at sort of a reasonable price. I'm not necessarily saying a bargain basement price, but a reasonable price. There's a very compelling argument for infrastructure. And if you want to point at something that could have been done better, I think governments, where they were worried about their debts rising too fast, were too much cutting back on these long-term infrastructure. You could add education things, which they shouldn't have worried about so much, and not being tough enough on other areas where maybe there was more room to cut. There's a greater debate about if the government should just spend money. I think there are all different perspectives. So there's this argument that there's a Keynesian multiplier, and it doesn't matter if you dig ditches and fill them in, the economy is going to grow. You can come up with theoretical models that say that. I think the empirical evidence that you really do have a big Keynesian multiplier that's much bigger than one. In other words, you spend money and it might not do anything, but there's another round and it does. It's pretty thin, in my opinion. Now, I have to say, I can find respected scholars from, say, Chicago and Berkeley. One of them will scream the multiplier's a quarter or it's zero. In other words, it's worse than nothing, spending government money. And the other one will say, no, it's 2.5. And they're all absolutely sure. So you can decide. Certainly, the casual empiricism in this hasn't clearly shown there's a remarkable departure from one, but it's something that there'll be a lot of studies about. But there are a lot of good infrastructure projects. Of course, there are, needless to say, in India, but there certainly are in the United States. So I think it's a somewhat taking the direction of the debate in the direction of should we be digging ditches, I think is not terribly constructive, because there actually are things like the electric grid, fixing bridges, lots of things that can be done in the United States, and also, at least in most parts of Europe, Germany's infrastructure, for example, their investment's been going down. I think that's something where there's fairly low-hanging fruit. Monetary policy. I mean, I first start by saying monetary policy has been probably more clearly effective than fiscal policy in this, and that fiscal policy worked at first and then hasn't played as large a role. But I have to tell you, it's very, very controversial. So I promised I'd talk about the tapering, and here's where I'm going to try to do it. And I think the first thing to say is that, and I think you know this, but I'll repeat it, this is a very experimental policy. Whatever confidence the policymakers deliver that they're going to do quantitative easing, how can they know? There are very few examples of this. We haven't seen a lot of examples of quantitative easing. And so, for example, we were promised that when it was time to end quantitative easing, there was nothing to worry about, because that they could, whatever the technical jargon was, they could withdraw it and you didn't have to worry about it. An analogy might be, I have a physics colleague, Lisa Randall, who's a very prominent physicist, who wrote a paper about what happened when the CERN, started this Large Hadron Collider, where there was a concern that it would create antimatter and we would all disappear into a singularity. And she wrote a paper saying that actually there will be antimatter, but you don't have to worry because the half-life is so short, it won't matter. We won't die or disappear, whatever it is. We won't even know it, I guess, when it happens. And I mean, I respect her enormously. She's brilliant. But I felt better after they turned it on and we were still here. I mean, maybe we're in a different universe and we've been beamed to somewhere else and we don't even know it. But I think we're still here. But I think on quantitative easing, it's on the blackboard. I've been teaching it for, I don't know, more than 15 years. It works great on my blackboard. You can, put it in and put it out, but it's not exactly clear, what happens because we don't have enough experience and we don't have enough knowledge. I think part of the problem with what's going on, which is difficult for the central bankers to communicate, I think they're candid about it, but people, gain, I think in a good way, so much confidence in central bankers, they don't listen. Maybe as they're intended to, but there's a lot of uncertainty. So there's uncertainty in the economy. There's uncertainty about what the right model is and what it's going to do. So we're in this situation after the financial crisis where not only is there the overhang of all this debt and all these other problems, Europe, which I'll come to, creating uncertainty, I wouldn't quite put it that they don't know what they're doing, but no one could be sure what they're doing. We don't know if we have the right model. So there's not just the usual uncertainty. We don't know what the supply shocks are going to be, but there's this qualitative uncertainty, which really is different, of not knowing more than usual what the right model is. Certainly in emerging markets, what this means is you're facing this multiplied uncertainty. And I don't blame the advanced policymakers for it because we don't know. But you're facing this uncertainty that they don't quite know what's going on because we never quite know what's going on, and they don't quite know what to do about it. If I were to describe the views at the Federal Reserve Board, and I say, viewing this from the outside, I would say there are 4 views about quantitative easing. The first view is that it was a perfectly terrible idea. It's going to cause a lot of inflation, and we shouldn't have done it. Another view is it's a perfectly terrible idea, but fortunately, it's not going to cause any inflation, but we shouldn't have done it. Then there's a view that it's a good idea, but unfortunately, it doesn't work to cause any inflation, and we wish it did. And then there's another view just saying, well, it really did work. And I really, these different views, and I could multiply them, come into a room looking at data which we don't necessarily, completely understand, looking at the employment numbers are better, inflation's lower, and it becomes very difficult to predict policy. I mean, if I had to guess, I will guess that tomorrow in U.S. time, the Fed will do a very modest taper and try to convince you that they're actually loosening monetary policy, but they're doing it a different way. But it's a very hard message to deliver because the markets have become very trained, and they were partly trained by the central banks, that this was the way that policy was being delivered, and so it's confusing. My own view, I've listed the Fed views on what they should have done, it's maybe slightly radical. I think they just didn't do it aggressively enough. I think that they should have more forthrightly raised their inflation, temporarily at least raised their inflation trajectory. They should have done quantitative easing instead of picking numbers, just saying we'll do what it takes, a little closer to what Kuroda is doing in Japan. And I actually went to Japan when I was chief economist at the IMF, and I had pretty much the same view. I mean, I've learned and stuff, but I had the same view then of what they should do. And I used an analogy and wrote it in some op-eds and used it of being in golf. I thought that was good in Japan, of being caught in a sand trap. And if your ball in golf is in a sand trap and you just tap it, it's not going anywhere. If you hit it firmly and ideally skillfully, it might not quite go where you want, but it would go to somewhere there was grass, and then you could adjust. The idea being that if you do quantitative easing wrong, it could the interest rates will eventually go up, and you could use normal monetary policy. But I don't think that's where things are going. I think that central banks, if I read the literature that they're putting out and the speeches that they're giving, has somewhat come to the conclusion that, well, that might be true on your blackboard, but we're not going to try it, and we're just going to try to phase out of this and pretend it never happened, and try to convince the markets that we're going to do this forward guidance instead, promise that interest rates will be low for a long time. Because the trouble with that is that if you're promising something but you don't have an instrument that you're delivering it somehow, it's hard to know how those things connect up. But that's certainly the next phase. The governor referred to my early work on central bank independence. I think I wrote the first theoretical paper on that. And I actually had a somewhat flexible view of how it would work. And in a situation where you were stuck in stagflation, you would want a fairly conservative central bank, not necessarily ultra conservative, but more conservative. I think in the advanced countries, we're in the opposite situation at the moment. And I wrote something supportive of Governor Yellen precisely when she was on her way to being appointed, precisely because I thought that she would be credible as someone who would maybe attach a higher weight on employment and a lower weight on inflation than a typical central bank governor, and that maybe this is a time to think about that and to go in that direction. We shall see. I generally think that inflation targeting became a little too much of a religion in the advanced countries and a little bit too inflexible. And I think we're suffering from that now, that the inflation rate's drifting down to 1% in both the Eurozone and the United States. And this is not a healthy situation in an over-leveraged economy. It's not a healthy situation in economies where wages don't adjust downward very, very easily. I was pick up on a couple other policy issues. There's a lot of new regulation, and frankly, if you're asking what the regulators were trying to do, let's face it, they were not trying to redesign the system. They were trying, as best they could, to resuscitate the existing system and say that they fixed the system. They were not trying to revolutionize things. If they were trying to revolutionize things, they would have thought more, first of all, they would have thought more about allowing senior bank debt to get written down in the middle of it, to try to do some deleveraging. Once Ireland guaranteed its senior bank debt, it started a chain reaction from the UK to the United States, and everybody did. And then it was very hard to dig your way out of it. But I'd also say going forward, they would think of ways to have less plain vanilla debt. I think Bob Shiller, I know, was in India last year and has been evangelical in trying to say that we should have other forms of debt. For example, government debt, he'd like indexed to GDP. Housing debt, he'd like indexed to some general regional housing index. And I actually think this kind of thing is a great idea and something where policymakers need to take some initiative. That a lot of the problems we have with having runs in financial markets in the advanced countries come from having this very simple debt where you absolutely get back what you put in, that the floor is guaranteed on it, that I think creates a lot of problems, particularly when applied to the broader market. When I think of 50 years from now again, I hope that that kind of banking account that we have today, where there's no indexation at all, our children will think of like a tape or a DVD, something that's just completely obsolete. I can't believe you ever had that. We would have a much more robust financial system if there were more indexing. I've mentioned, I thought there was opportunities to write down debts, and I want to underscore, I think particularly in the U.S., they could have done more to write down mortgages, and it would have been a great idea. It would have been painful. It's not easy to do, but there were ideas. Marty Feldstein had a proposal that I thought was very good, involving basically taking over some of the subprime debt in exchange for some of the upside in housing. And I think the periphery debt in the Eurozone has yet to be written down to the levels that it needs to be sustainable. If not written down, then extended at low interest rates, some moral equivalent of that. So certainly when we talk about policy responses and the financial crisis, if you think that we had an over-leveraged society, if we're in a situation of over-leverage, you would have liked to have found ways to write down the debts. In my book with Reinhard, we look at emerging markets and show that there are actually very few examples where you just grow your way out, or in the rhetoric of the day, apply pure austerity. We show that that almost never works, that that's not something, that always is very effective. And I guess in some of our more recent writings show that when you look at advanced countries, they have a lot of tricks they pull out of their hat in order to deal with high debt. One of them being financial repression, but that involves having a decent inflation rate, which we don't. There also actually have been write-downs and defaults. I will pause just briefly on the Eurozone, very briefly, to say that it's not over till it's over. It's still a work in progress, and I think it's still one of the deep sources of uncertainty in the system. They've, monetary policy has been very helpful in providing a bridge, but the bridge has to go somewhere, and I think the politicians have to provide some framework for something much more like a political union in the Eurozone, and I think that creates still a lot of uncertainty. The one piece of it that I think we have to see is to have debt written down. Let me just conclude with a couple other points. If you look at this issue of slow growth in the advanced economies, and to some extent in the emerging markets like India, but it's a global problem, I think the thing which is much harder to tackle is the issue of growing inequality. And when you have a period of very rapid change, it does often tend to increase inequality. There's a debate about, is this all policy-driven? Is it tax changes? Does it have to do with the way technology works? And I think a quick assessment, it's got to be some of both. There's certainly evidence that in countries where the taxes on the upper income were cut more, the inequality has been greater. But there's also evidence the inequality has just increased a lot everywhere. And so it's clear that there's some of these larger forces going on. A former colleague of mine when I was at Princeton, and still at Princeton's Angus Deaton, who's a great scholar in development, has written a wonderful book recently about inequality. He basically, shows that, of course, often faster growth leads to higher inequality. But he also states as his thesis that, if you look at broader measures for the vast majority of people, and he's extending to the entire world here, and, he says something along the lines of there's never been a better time to be alive. It has gotten better. But I think the issue of inequality is that we're social creatures, and it's not just about, what we have. It's the community we live in. I sometimes think about, maybe it's only because I'm an economist, but sometimes think about, do I actually care if my grandchildren or great-grandchildren are 2 times better off than me or 4 times better off than me? I actually don't care at all. I mean, I wouldn't even care. I'd be quite happy if they were, the same. And by me, I mean my society that I live in. But, I would say, well, has the rest of the society multiplied times 20? Has growth not gone up in the United States, but it's gone up by a factor of 40 in China? There are these very difficult questions where a part of poverty that's very important, a part of inequality, has to do with relative factors. And certainly, you're familiar with these, or from Piketty on Saez. This is the share of the top 10% in the United States. It's more extreme than in other countries, but you see it in other countries where, in the beginning of the 1900s, it was very high. They had almost 50%, and then it went down to just mid to lower 30s, and now it's back up almost to 50%. So that's something that's quite dramatic. Now, one of the explanations for why this is going on has been developed in a series of papers by a couple former students of mine who are now, I guess, were colleagues of yours for a while at Chicago, Brent Naiman and Luca Carbanas, who say that actually there are technological factors that are raising capital share in production and lowering labor share, and that's a big factor in what's going on in driving some of these big divisions that we're seeing, both why the stock markets are high and why we see such flat labor. So when I was a graduate student and for some time after, it was just sort of an immutable constant in the United States that labor got 2/3 of income. Whatever the growth rate was, labor got 2/3 of it over any long period. And in other countries, it was a slightly different number, but it was similar. It was amazingly flat. And there's a model, I won't bore you with it, that delivers that. But it was just sort of a fact of nature. And so growth was good. I mean, whatever was going on, growth was good. And, sometimes this was held up in political economy as an example why Marx was wrong, because labor, no matter what happened, labor kept getting 2/3. We have gone through a sustained period where labor share has gone down. And this is a graph of global labor share where the dark lines, just the corporate sector, which you measure better, and the dashed line is overall. And you see this downward drift where it has gone down. This is globally, but you can look at it country by country, and you get something very, very similar, that the share of labor has been going down. The explanation they give, I don't want to get into the technical economics of it, but the basic explanation is that historically, when capital's gotten cheaper, the firms, the production, the amount spent on capital has only gone up proportionately. It has not. Firms have responded to the fact that it's getting cheaper, but they haven't, say, aggressively responded to the fact it's getting cheaper. But we're going through a long period, where that's been the case, where capital is getting cheaper and more production, more and more money in production is being spent on it. So this is something you just see all over the world. And again, I'm presenting this, and I want to be careful. We don't know. There need to be lots of other studies. It's always difficult to interpret macroeconomic data, but this seems to be one of the driving forces. I don't think there are easy answers to this. I would certainly agree with those who say, that the tax system needs to play a role, although I think there are limits to what you can do there. I think that if you look at work by my colleagues, Claudia Golden and Larry Katz, and I don't need to explain this in India, it is the people who have a high level of education have benefited in much the way capital has. It's your human capital instead of your physical capital. And so that's been also another driving force. And so we have to find ways to have more adult education, and not just vocational retraining. I actually think there needs to be a much broader notion of what education is. My mother was a librarian, and it drove her crazy that the state legislature in New York, we lived in Rochester, New York, couldn't see libraries as education. They just didn't think about it that way. And so libraries kept getting cut, and of course we have the internet and many other things now. There are, coming out of these, these interesting meta questions. I'm certainly not going to try to critique the Pope. I think he actually gave a very cogent argument recently about these issues. I won't necessarily, ascribe to every view, but he argued I think very cogently for, having more compassionate capitalism. I think it does raise the question of, if you do this in one country and the other countries aren't doing it, and we live in a world where we're not all, there are lots of tensions and geopolitical concerns, is this something we can achieve? And I think that's a question for mankind going forward. Finally, let me conclude talking about India, where I come and I study it, but I'm certainly not going to pretend anywhere, much less these halls, to know as much about it as all of you. But I would say you're worrying about the taper tomorrow. I think this period of policy, and you were worried about the Eurozone before that, I think this period of uncertainty and potential slow growth is just a fact of life that you have to adjust to. There's been this financial crisis. Not only are things bad, but no one quite knows what to do. Some people are sure they know what to do, but I think we don't quite know what to do. There's been this financial crisis that is going to create uncertainty, if not, the debt talks, then the taper, and I think this is something. This is a fact of life. On the other hand, I think you should feel perfectly free to give opinions on what should be done, especially when these policies have an impact on you. Behavioral economics, you may know this, but has developed this term internality, meaning maybe you're addicted to smoking or wrong kinds of food, and it's bad for you. It's an internality. It's your own addiction. But an internality, which isn't a social problem in itself, can turn into an externality when, for example, you're secondhand smoke, or where you're affecting expenditures in the health system, and there are a whole bunch of examples like this. So there's this thought about we want to address internalities because we care about people, but they sometimes turn into externalities. You could make this analogy to say some of, giving advice on policy decisions, and when we're looking at things like quantitative easing. I think on the one hand, there's a lot of uncertainty, and it's just not pleasant for anyone to deal with. On the other hand, I think that advanced countries have been altogether too closed to listening to outside advice. That was particularly acute at the beginning of the financial crisis, when they pretended it wasn't a financial crisis and wouldn't talk to leaders from emerging. They wouldn't listen seriously to leaders from emerging markets who had been in financial crises and knew how to deal with it. Of course, you need continuing structural reforms. And when I came here, I think in 2002, the first time when I was at the International Monetary Fund, one of the big issues were product markets, labor market reform, and particularly, but also in goods markets. And I think it's well recognized that that's still an issue. There are things India's done very well. I have to say, having not been, I couldn't believe it when I flew into the airport and I went over the ceiling bridge. And if clearly India can deliver, more infrastructure like that, this would be, fantastically useful. And I understand all the political issues, and I appreciate that India's continued to do reforms. But unfortunately, whatever the problems are, whatever the obstacles are, you need to find ways to work around it, because that is the way forward. And when I prepared for this lecture and read what L.K. Jha had said, it was very interesting that I think he had great foresight about this, and I think he's given credit for being sensitive to the environment and sensitive to what can be done, how quickly. But this was very much at the back of his mind. So I will close with that theme. Thank you. Okay.
I think Ken, I think there's some time for questions, and perhaps people from the audience can raise hands and ask. Gentlemen.
Hi, I'm Gangadhar. In the context of central bank independence that you just mentioned, one of the offshoots of the financial crisis, recent financial crisis, is there is an increasing tug of war between governments and central banks in the regulatory space to control the financial system, with governments asking more focus on the central banks to focus on traditional monetary policy, and issues like financial stability be handled by the governments directly or indirectly. Do you have a view on what is the optimal mix in the background of the financial crisis that we have seen?
Well, I think part of why the central banks took on such a, can you hear, is this working? Part of why the central banks. Oh, that was muted. Okay, sorry. Forgive me. I think what happened during the financial crisis in many countries and continues to happen is there were many governments that were paralyzed. The central banks were not. And so they ended up taking on responsibilities that they hadn't anticipated. I'm sure in the case of the United States, some of the things for which the Fed is given great credit, and it was enormously creative in the financial crisis, it would have preferred the Treasury did. And if we're talking about buying consumer credit or even the mortgages, this is Treasury stuff that it should do, but they just couldn't get it together to do it. You see this even more in the case of Europe, where the ECB is really by far the healthiest pan-European institution. So you sort of see what's working and pile everything into it, and a balance needs to be struck. I think most central bankers feel, especially after the financial crisis, that it is important to have a regulatory regulatory overview that's quite significant, because otherwise you can't react in a financial crisis. But I think it's something where it needs to evolve further. It is not as, and I only know this in the U.S. and Western context, and I don't know it in the Indian context for sure. But it's hard to protect monetary policy. It's very hard. It's very hard to, because of course it has redistributive consequences. If the Fed changes quantitative easing or raises the interest rate, it helps some people and it hurts some people. So there's a lot of lobbying. But when you come to regulation, it's much harder because it's much more targeted. The lobby groups come in heavy. The people who are affected are much more, So I certainly can tell you that before the financial crisis, I was told by regulators in a number of countries that they thought there was a problem, and I won't go more specific than that. They thought there was a problem, and when they started to pursue it, they'd get a call from someone in the legislature, sometimes the Prime Minister's office, back off. Things are going good. So I think that's a difficult problem that needs to be adjusted to. And the more central banks take those on, of course, the more vulnerable they become to that. That's a big concern in the central banking community. How can we keep monetary policy independent as our regulatory profile rises, which is much harder to shelter from political influence?
Professor Rogoff, there's some work by David Wilcox and other authors of the Fed, which basically makes the point that potential output or aggregate supply is now endogenous to aggregate demand conditions, that if demand's weak enough, you have trend declines in labor force participation, hysteresis, capital formations weaker, and therefore the implication is that policy, monetary policy in particular, should be even more aggressive because the lack of not being so has implications for potential output in the near term. That's a raging debate in India as well, where you have high inflation, but the sense is perhaps you need to, have looser policy to try and stimulate investment and try and boost potential growth. What are your thoughts on that stream of research at the Fed?
Well, I mean, it was actually another Fed paper. I referred to one paper. There was one paper. There were a couple papers at this recent conference I was at, and of course there has to be something to it. I think that it's difficult to calibrate in real time. I mean, certainly if you look backwards, you would have, I would say, in many countries, you might have done more stimulus of one form or another. But at the time, you didn't know if the world was going to fall apart. We went through a couple years where it looked like the Eurozone could fall apart, and different people took different stances. There, some very widely read voices, like Paul Krugman at the New York Times, said, frequently said over a couple-year period that the Eurozone's about to collapse. And if you're the policymaker and you think the Eurozone's about to collapse, you're going to sort of keep your powder dry and wait and see what happens. Now, everybody was worried about that. I think looking backwards, if you had been promised that that wouldn't happen, you would adjust. So we've gone through this period of tremendous uncertainty. And of course, you would do things a little differently with the benefit of hindsight. I mean, I think there are clearly a lot of supply-side things. I mentioned infrastructure, education. There are a lot of things to be done. I mean, I think India's, I again know much less than all of you, but it's clearly in a different place at the moment than the United States or Europe. We have uncomfortably low inflation and unemployment. You have uncomfortably high inflation and unemployment. So, I mean, it wouldn't necessarily have struck me as the time where it's not the same necessarily conclusion when inflation's sort of gotten high that you would get when in the United States it's lower than anyone wants it. So, but these are difficult questions.
Professor, basically what I discern from your talk today is that possibly you are okay with flexible inflation targeting, and what we learned from this lesson was that it was like a more hard inflation targeting which landed us in this kind of a problem. Is this your view, or is it that probably the central banks have missed the possible battery of instruments which they conventionally used to use earlier, also targeting reserves, for instance, using reserve requirements, for instance, and not putting all its eggs in one basket of targeting a short-term nominal interest rate. So what is the position there on?
I mean, I think this is getting into central bank speak, but I mean, the term flexible inflation targeting, as I read it, is very flexible. And so everyone's doing flexible inflation targeting. It doesn't matter what they're doing flexible inflation targeting. I think there are elements people would say where it has to do with transparency, clarity, perhaps. But I actually would say that back in my original paper, I made a big deal of it actually matters who the people are at your central bank and their competence, their beliefs. That actually matters. And I think that's true. And my paper was written after the stagflation of the 1970s, and I sort of concluded that when inflation expectations are high, you want to convince people their inflation's not going to stay high. That's the challenge. And I actually think that most of the time, and probably at some future date in the advanced economies, that will be the challenge. That's not the challenge at the moment. The challenge at the moment is that they say they want inflation to be higher, and nobody quite believes that they're willing to deliver that.
Two questions, if I may. One is, you talked about
things working on the blackboard. How would you read Japan's experience with infrastructure investment? Because they attempted it at a time of low interest rates, but it didn't seem to have worked. In another part of your talk, you basically argued that that's because monetary policy was not doing its role. So the question is that for those who are skeptical about infrastructure, what's the story on Japanese infrastructure you would give them? And since both of you have been chief economists of the IMF, your narrative was basically country by country. Was there a big opportunity in global coordination that's been missed? And is there actually a big agenda on international monetary reform that we ought to be thinking about?
I mean, clearly the United States today has a lot of infrastructure projects that look kind of reasonable, and Japan ran out of them at some point, but kept on doing them for political reasons. And there were many things they didn't do. Their hospital system lagged, for example, for a long time. So I made the qualification that infrastructure spending that has a decent rate of return, you should do. And this is a good time to do it. It's not a good time to just do anything. So that's not an easy thing to do, of finding what works and what doesn't work. I think the United States, there's so much deferred maintenance, and if I may, the United States has had a big emphasis on private consumption and a small emphasis on public consumption in recent decades, certainly post-Reagan. And I think there's somewhat of an imbalance, sort of larger and larger houses, but, many basic things left to decay, and there's sort of a real incongruity there. I mean, Japan's, clearly in a different place. On international policy coordination, John Taylor wrote an interesting paper that I was a discussant of over the summer, where he pointed out that, there had been a consensus that in ordinary times, if countries would just keep their own house in order, there was room for international policy coordination, but it was okay overall. It wasn't a big deal if you didn't have it. But he said, we're not in that situation now. We're in a completely unknown situation, and we can't necessarily assume that the same papers we refer to, ideas we refer to, don't necessarily apply. So certainly if we stay in this situation for an extended period, I think it is something which could be revisited. I worked in that literature, and we didn't explore this issue. We didn't imagine it. And so it's certainly an interesting question going forward. I treated it somewhat cursorily to, I think that's very clear is if you have a big neighbor or big player following bad monetary policy where they're not even doing the right thing for themselves, that can have pretty significant spillover effects.
The monetary policy again formulated looking at the domestic objective of inflation and growth. But obviously there are spillover effects because there could be a debate whether QE worked in US context or not, how well it worked. But certainly it's very clear that it has spillover effects for the rest of the world, and particularly the emerging markets and developing countries. And it creates a lot of instability and volatility in the system. So what is the kind of a defense, that policy defense that one could have? Because it is easier said than done that you do structural reform. It cannot be done in the short term. It takes time. So perhaps one policy or defense is that to build up reserves and manage the exchange rate heavily. I think that was a view, and perhaps post-crisis now, that view again is gaining ground because countries see that they don't have a natural defense. What would be your comment on this?
Could you just repeat the very last part of what your comment?
No, I'm saying that you build up reserves, foreign exchange reserves, and manage the exchange rate, because you had certain views on the exchange rate that should be flexible, so that you get in for a managed exchange rate and build up foreign exchange reserves in the system as a defense against, guard against the spillover effects.
It's I don't have a glib answer to that question, and you deal with it every day. So I'm not sure I have a simple answer to that, and it depends a lot on other imperfections in your system. For example, somewhat unique to India is the fiscal situation is extraordinarily sensitive to the exchange rate because of the import price of oil. And so if you don't have a way of adjusting that, it forces you to, be more concerned about the exchange rate perhaps than you otherwise would. Certainly building up reserves protects you against a crisis, but I don't know that it protects you against this short-term volatility. I thought it was very interesting during the financial crisis that even though Korea had a ton of foreign exchange reserves, suddenly the U.S. signs a swap arrangement for a tiny fraction of what their reserves are, and there's stability all of a sudden. So I think the reserves are a protection against financial crisis to some extent because it gives you a backstop, but it's not necessarily easy to micromanage on a day-to-day basis the exchange rate fluctuations. Just because the pressures can be so big, the reserves can move up or down, and the exchange rate does provide some equilibration. However, I recognize that these fiscal pressures that make it difficult to allow big swings in some contexts.
Last question.
I saw very interesting chart. I don't remember how you decided to
Hi, I'm Prasad. I saw a very interesting chart in your presentation that whenever top 10% have the 50% or more wealth, actually if I look at it very carefully, actually the crisis has happened. When it gone down to 20 to 30% range, during that period the US had more inclusive and much better growth. So is it something that when too much of wealth is accumulated by very few, and then the masses try to borrow and spend it, and that leads to some kind of crisis? Because I do not remember anything reading in the This Time is Different, which is one of the best pieces, and I give it to all people to read. So I would like to know more on that, inclusive growth or some kind of inequality and crisis.
Well, first of all, I can't help to say, but there was a book that dealt with this issue where Governor Rajan had a chapter called Let Them Eat Credit, precisely about this political economy where they would try to make consumption more equal even if income wasn't more equal. Certainly Deaton looks at this and many others, and there's a big literature and it's an open question, but my take of it is that when you have these periods of big technological change and that's generating the fast growth, that often does lead to more inequality temporarily. Although it's difficult to evaluate over the longer term. For example, medical advances eventually pass through to a large majority of people. There are things like cell phones that I mentioned we don't even know how to think about, and how that benefits welfare. So I certainly would say that credit is something to be careful about. But if we could go to this perhaps utopian world of Schiller's where more of it was indexed, we really wouldn't have to worry about it so much. And if I want to add, are we still going to be doing this in 200 years? So, as somebody in 200 years, we wrote a book, 8 Centuries of Financial Folly, and somebody will think, what a cute title, 10 Centuries of Financial Folly, 200 years from now. I hope not, and I think I think there is room for financial innovation that would provide some protection. There's no protection against human nature. So maybe when all this is done, it'll just lead to another layer. But I think it would buy us at least a lot more peace than we've had. But they're very tough questions.
Great. Hello.
Thank you very much, Ken. As a flexible inflation targeter, note to journalists that was meant as a joke. Let me thank you for a really wide-ranging, illuminating, and informative talk, and I hope all of you will join me. This is a small token of our appreciation for you taking the And I think if there's one thing we take away from this talk, where we spoke about chess, secular stagnation, over-leveraging, deleveraging, labor share, libraries as a means of education, I think if there's one thing we take away, it is that there is tremendous uncertainty associated with real economic policy making. And as Ken said, always be skeptical when someone says they know. I think at the Reserve Bank of India, we've always followed this path of being very skeptical of ideologies and very pragmatic. And I think that certainly is in the spirit of Mr. L.K. Jha. And with that, let me invite you all to join us for IT. Thank you very much.